Now recording.
All right. So, welcome everybody who is here to the June 28, 2023 Aladdin Community Call. So, I am taking the front seat right now because our friend K-Metz is tied up with something in the real world. He's got an early meeting because it is super hot where he is. So, we're going to potentially hear from him. He may jump on a little bit later. But for now, I'm going to be flying solo. So I apologize in advance. The um, the the agenda is going to be as usual. We've got a few sort of housekeeping items to talk about, and then the meaty one, as usual, for the last few weeks is going to be f of x. We have incorporated a few new a few adjustments, a few tweaks as we sort of progress along to this what we're calling the V2 or the second sort of the liquid staked ETH backed version of f of x that we are actually going to roll out as the first version to hit mainnet. So details about that, and we're going to punt that to the end, and then of course, as always, Charlene's macro view to round it out. So I will kick off here with just some general Aladdin stuff. So the first thing on my list here is that the ALD and ETH gauge vote is officially live on Curve. Do you have that link, Paul? Maybe you can drop that into the call channel. But in addition to that, so because
sorry, Kruger. Sorry to interrupt you.
Please.
Could I actually go first?
Oh yeah. Sorry, I forgot. We should do that after all. Okay. I'm not gonna. Don't, Paul. Do not share that link.
No, not yet.
Keep it secret. Keep it secret. Keep it safe until the end. All right. So sorry. Let's rejigger. Charlene's macro first.
Okay. All right. So good morning, everyone. I think we shouldn't call this section Charlene's macro update. It should be Charlene's unpopular opinions.
Charlene's travel log.
About market collapses. Well, market keeps posting new highs.
Mm-hmm.
So let's start with something bullish today. The U.S. new home sales actually jumped 12.2% to 763,000 units in May. With that, the rising interest rate has killed housing market. Well, the data shows that U.S. housing market is stronger than ever. So where the growth actually came from? So likely from average households who need to take on mortgage to buy houses, right? Because people tend not to take up mortgages while interest rates keeps moving up. So let's look somewhere else. Surprisingly, U.S. population has grown by 0.5% this year to 334 million. That's huge, right? For a big country like America. And the population growth for the last 3 years has reached 1.2%. And most of that growth came from immigrants. So it seems that people came to the country in the last couple of years, are buying houses and start contributing to the economy. That's very healthy. And Canada is actually more aggressive. Canadian population has grown by 0.85% in the past year, and it's reaching 40 million. And population growth for the last 3 years has reached 2.3%. So US and Canada are very smart to grow the pie during economic downturn. And let's also check out how the other major countries have been doing on population side in the past year. I will rank them by the growth rate from high to low. Australia, 1%. New Zealand, 0.8%. India, 0.8%. India has very strong demographic distribution as well, because they just keep making babies. And UK is 0.3%. and France is 0.2%. Germany, flat. China, flat. Russia, negative 0.2%. And Japan, negative 0.5%. So population is really the single most important fundamental driver for economic growth. It seems that many developed countries have activated the fighting for population mode to fight for economic growth. So, and back on general market, the most important episode is being played out. July is the month to show final cards for major central banks, and Bitcoin continues to test its status as safe haven assets. Why we can't tell with a high level of confidence if Bitcoin and crypto will stand out against the TradFi asset classes if big collapse is coming. Because first of all, we're not super information carrier. We don't know what exactly are being cooked at the regulators and institutional size. And also crypto has very limited track record and this lack of statistical support to justify its safe haven asset status for sure, right? So for times like this, right, people on the right side of the curve and even left side of the curve tend to do a lot better than mid-curve the people like myself. It's helpful for us to get micro right as we can earn beta's return. However, macro is a very fast changing space with too many drivers and randomness. And the alternative strategy is, obviously focus on beta. Like Warren Buffett never looks at macro, right? He publicly, said, we don't really care about macro. We just focus on companies' fundamentals. He primarily focused on research on companies and products, and why he did that and has been so successful. Because human nature doesn't change, right? At least it hasn't changed from the last threshold of biological evolution process. We work on the same biological and psychological mechanisms as our ancestors in the jungle. And so people always need and pay for certain things. So Warren Buffett only invests in things, right, he thinks that don't change much. Regardless of how deep we go into the technical revolutions, we still need to eat candies and drink sugar water. And that's it this week. Hope it helps.
Interesting.
We should definitely get Cody.
Interesting. Charlene with a little bit of a different perspective than we usually hear from her on the macro update. So that's exciting.
Yeah, bro. Common sense tell me U.S. economy doesn't have a recession. Just the people everywhere spending. Very strong. Yep. Very robust.
What about you, Cody? What did you buy today?
Oh, I've been buying nothing, I'll tell you. I actually have little clue what's going on. I've been traveling for the past couple of weeks, so I've largely been out of the game.
I don't mean assets, I mean toys. Like
toys.
Well, Charlene's talking about how everybody's out spending money in the US economy. I thought that would be you too.
No, man, we're heads down. I'm curious if some of the housing stuff will be like a later term effect, because like a lot of people, they rationalize the interest rate, but I feel like it can come to bite you later on.
Yeah, I mean, like, there's also, I would be interested to see what the breakdown is of like private ownership versus like corporate ownership versus like individual for family ownership, right?
Yeah.
Because the especially in the States, like the incentives to buy homes based like when the interest rates are high, it's really bad. Like because their mortgages don't expire. Like in Canada, we've got these short everything is on a short term, right? Like up to only a maximum of 5 years. So even if you get in at a really low interest rate, the maximum you can ride it for is, a few years, and then you're exposed to the. But conversely, if the interest rate is really high, you're not locking in at like a super high amount forever. You're paying it until, rates come down, right? There's a lag because of those like multi-year mortgages, but they're not 15, 20, 25-year fixed. They're, you can't get a fixed mortgage rate any more than 5.
Only downside though, because like, say you have a really good interest rate in a place like Canada, but it expires, and then you're kind of screwed. You have to take on something with a higher rate. But, if you're in the States, if interest rates go down to 2% tomorrow, like you can refinance. And there's some cost with that, obviously. But if it's a significant enough change, it's worth it. Though, but like, it's tough because depending on the economy, like I don't think many banks are doing any refinances right now. So, I mean, I'm sure you can find it if you really want to, but like it wouldn't make sense to refinance for almost anyone right now.
Right.
So
yeah, that's true. I mean, it's a hell of a set of hoops they make you jump through to do that, to break an existing mortgage. Like I think if it's anything like it is here, the calculation for how much it costs to break that mortgage is based on how much interest you would have paid over the rest of the lifetime of the mortgage.
Yeah, and I'm sure it's similar. Yeah.
Those refinancing fees, like they're bad here with a maximum of 5 years. I can't imagine, like if you locked yourself into a 25-year rate and then you tried to refinance down, unless the rules are different, it would be crazy.
It's not that bad. I mean, like obviously you're paying. I don't know what the math would work out to be, but like it's definitely not 30 years of accrued interest difference that you pay.
Yeah,
it's it's going to be many multiples less of that, but it's still like a decent fee for sure. So you can't just go refinancing every 5 years and come out ahead probably.
Right. Interesting times. Anyway, well, thanks Charlene for your update, and I will go ahead and just jump back into the agenda. So Paul, do you want to share that link now that we've been hiding? The ALD and ETH gauge vote is up on Curve, which means that all VE Curve holders can vote on it. And through all of our chain of connections, the CVX that is held by VE Clev, ALD and VE Clev voters can vote on the same thing, right? Remembering that for non-gauge governance votes, that Clev controls the CVX that is locked in Clever. So anybody who is a Clev token holder should absolutely get over to the snapshot and vote. Same thing with ALD. We want to make sure to have good participation in that. There's I believe a 10% quorum. And we'll get those done so that we can direct the CVX that Clever controls to supporting that ALD and ETH gauge vote. All right, I'm going to drop some of these links in.
Don't worry, I'm on it.
Oh, you got it. You got it, Paul.
Yeah,
okay.
Yeah.
All right. Okay. So let's move on to Concentrator. So that's all the Aladdin update. Minor update for Concentrator here, just that we have the fee distribution. We mentioned, I think, on the Discord a little while ago. I don't think we tweeted this. We mentioned that we had a bunch of accrued fees that were that had been piling up for a little while on some of the compounders. And so we had accrued just a little over 80,000 A-curve worth of fees from all of the different harvesters. And so the fee distribution for that kind of lump sum is going to happen tomorrow, I believe, at 0. Actually, for Eastern time people, it'll be tonight, I think, at 8 o'clock. So 0 UTC on Thursday. And that is going to be kind of like a big blob of stuff that has been accruing for a little while, and then we will continue with ongoing revenue distribution for all of the compounders that were previously just accruing revenue. They'll now be part of the regular distribution. So look for a big chunk. Make sure to extend your locks this week today, if you haven't already. And if you want to lock any more, probably better to do it sooner. It's not a huge amount, but 80,000 A-curve is not nothing. And yeah, so but also going forward, look for the return on VE curve to bump up a little bit now that we're distributing all of those. We're distributing all of the profits from all of those different compounders going forward. Second concentrator update is we have rolled out a ton of new ASD curve harvesters. So ASD curve up until just this week was only a compounder. So you could only participate in it by dropping your SD curve or your curve and just auto compounding the yields. But that's not really the magic of concentrator. The magic comes from being able to have assets in any of these different like convex vaults and harvesting all of those rewards and concentrating them into ASD curve or into your preferred compounder. So as of this week, we rolled out a whole host of harvester vaults that all concentrate into ASD curve. So given that ASD curve, I tweeted this week, that ASD curve has been the dominant compounder on concentrator for quite a while now. It quickly took over the TVL race. I think it only took a couple of weeks, Paul, something like that.
Yeah.
But it's held its top position ever since then. And I have a feeling that that's going to make these harvesters attractive, and then the harvesters should in turn make ASD curve more attractive, and they'll form a pipeline of like ongoing rewards being pumped into ASD curve. So it's all good news on the ASD curve front. So check out that tweet. There's the list. I have the list in front of me right now, but it's a big long list of harvesters. If you go to the concentrator UI on the concentrator website, you'll see now when you under the vaults tab, you can actually check ASD curve and sort, like filter all of the harvesters to show only the ASD curve ones. So there's TriCrypto, there's Curve USD and USDC, which is paying over 10%. Lots of really interesting stuff there, and I can see actually already that the wow, they've already got. Oh wait, no, sorry, I'm misreading that. Yeah, so we'll have to wait and see which of those ASD curve harvesters picks up first. The UI shows just total TVL for all different compounders for each of those. So I don't actually have in front of me how much TVL is in just the ASD curve focused ones. But they also rolled out over only a couple of days ago. So we'll check back in on that next week. All right. So I'm looking at my agenda. That's everything I have for concentrator. We can jump into Clever. A couple of points of update for Clever, which first round 47 completed this week. Some stats. We had over 2.5 million CVX locked for this one, and for a harvest of over 25,000 CVX. And so over 20,000 of that was made its way into the furnace to be vested over the next week or two and convert everybody's furnace deposits over into CVX. So another successful harvesting round, everything looking good on Clever. Second thing is that the community booster round is over. So we'll have some stats to share about how the votes went and how the allocation of the next round of booster rewards is going to be doled out. But you can see if you go to the snapshot, you can see the results of those votes there. And remember, we combine the XALD and the VE Clev voting power in the usual way, right? XALD controls Aladdin's share, and we use that to calculate how the Clev rewards will be distributed. So keep an eye out on our Twitter for that soon. Generally, what happens is we make up a spreadsheet that kind of shows all of the boosters and the rewards that they will earn, and we'll post that for people to review. And then the vesting will kick off. So hopefully, maybe next week or the week after, we'll be able to announce the start of the Clev round 7 and 8 booster reward distribution. Okay. Okay, Paul, you're going to have to play K-Mets for me here. Have I missed anything?
No, I think you covered everything. And
that's all the non-F of X stuff, right?
Exactly. Now it's time to go to the hottest part of the call.
Yeah, the meat. It's time for the
Exactly.
meat. Okay. So let me see.
Shall I share the presentation link so anyone can have a look? Or
Yeah,
just
absolutely.
on
Well, I can.
screen
Let me see here. I've got a window ready. Here, I'm gonna go ahead and go live on my window if you like. Do you want to tell me if you can see me?
I'm waiting. Yep.
All right. So if we do
Let's see.
this, is that
Stream closed.
stream closed? Okay, you're being difficult. What about this?
Yep. Work.
Okay. All right. So I'm not sure if that's going to show up on the YouTube stream or not, but we can we can play with it. So this is the slide deck. We showed this a few weeks ago when we first launched FFX. We put together a slide deck to just kind of explain high level what it is that FFX does. I'm going to step through it in kind of right now, just so that we can produce a nice recording that we can put on YouTube and point people to if they want to see some details. But also, I'm going to try to highlight some of the changes that we've made because we've been gathering community feedback and making adjustments to the way the mechanism works while we've been running on testnet. So we've got one fairly big change that we're rolling out compared to the testnet version, which is going to be instead of using pure ETH in their reserve, we're actually going to switch over to staked ETH. And so I'll try to highlight that a little bit in these slides, talk a little bit about the main changes and the implications of that. But in general, we're going to step through sort of from the beginning. So kick it off. This is FFX protocol. What it does is it takes Ethereum and it breaks it into two pieces. It breaks it into a high volatility token called XETH and a low volatility token called FETH. All right. What does that mean? Low volatility, high volatility. So for FETH, you can think of it like a sort of a floating stable coin. It's not tied to any fiat currency, but its value changes at 1/10 the rate that ETH's value changes, denominated in US dollars. So if ETH goes up 10% in USD terms, then FETH goes up 1%. And you can see that the idea here is we're not trying to peg to a hard dollar, but we're trying to really peg to ETH, but just without all of the rapid volatility in the price movements. On the flip side of that, you have XETH, which is a leveraged long perp. The leverage varies from 1 to 4x, and we can talk about that a little bit more later. But the main takeaway for XETH is that its price moves at more than the rate of ETH. It's like a leveraged ETH, but there are zero funding costs. This is very, very different than the perp platforms that you are used to. You do not have to pay anything to hold this leveraged long ETH position for XETH. So let's dig in here. Expanding a little bit more on FETH. We talked a lot internally about whether to call it a stable coin or a steady coin or a flat coin or whatever. You can pick your poison on this. But the main purpose of FETH is to fill the same role that stable coins currently fill, which is to say you want something that is low enough volatility that you can plan for future expenses. You can use it to trade in and out of the main volatility of crypto. So holding FETH versus holding ETH. It does the same kind of function as a stable coin would there if you want to buy or sell into or out of crypto. And to just be money at rest, right? To be money that is available to be spent, that's not currently, invested or exposed to anything that has a higher volatility. But the key here is that in contrast to stablecoins, FETH is able to do this with a very high level of decentralization and a very high level of scalability and high what you might call available liquidity. So this combination of decentralization and scalability is what we really identified as something that's missing. And so having those together in this mechanism, we think is kind of the secret sauce. Is really what makes it so powerful. And then you can call it long-term fiat inflation hedging. That's just kind of another way of saying, holding FETH, you are still a little bit exposed to the crypto market, right? Like if you are still enjoying some of the relative gains of ETH versus USD. And so if your thesis is that that crypto is going to, or that fiat currencies and USD in particular are going to devalue over time versus crypto, you can think of FETH as an inflation hedge. On the other side, there's XETH. So XETH is a totally composable on-chain leverage long ETH perpetual that has no funding costs, a very small chance of total liquidation, by which I mean, and here in this case, a total liquidation just means the price of XETH going to zero. So everything that we have built within in the stability mechanism is all designed to prevent that from ever happening, because the protocol needs XETH to exist. So the byproduct of that is that we're going to work extremely hard to protect the value of XETH if it's ever vulnerable. And the leverage of it's variable. It goes from 1 up to 4x effective leverage. And we're going to talk a little bit more about how that happens and everything else. But the high level picture is that the leverage varies depending on how much FETH versus how much XETH has been minted against the reserve. And we'll see more how that works in a sec. So the big story here is that FETH and XETH support each other, right? What we're doing in the way of all great DeFi is that we're connecting participants, connecting different people who have different needs together in a way that benefits both of them. So the FETH holders are, by holding FETH, they actually increase the leverage that XETH holders get. And the XETH holders are absorbing all of the volatility, right? By taking that leverage position, they're absorbing all the volatility that the FETH holders are giving away. They don't want it because they want that stability. So let's talk about what we call the f of x invariant. So this is just kind of like the simple equation that governs the whole way that f of x works. And it says that the market cap of FETH plus the market cap of XETH equals the total value of all the collateral in the protocol, right? And what that means is that every FETH and XETH is always fully backed, but the amount of ETH backing each FETH and XETH is varying based on the price of ETH, right? And so you see in this diagram here, and one of K-Metz's great diagrams is that if there was $200 worth of ETH in the reserve, you might have a situation where $100 of that is in XETH and $100 is in FETH. And of course, those individual fractions can change of FETH and XETH, but they always together add up to the total ETH reserve. We talk about the volatility partition, right? A way of dividing, taking the volatility from the whole reserve, concentrating the volatility onto the XETH side, and protecting or leaving the FETH side nice and stable. And so when there's a change in the ETH price, the FETH net NAV, right, the net asset value, moves a little, and the XETH price moves a lot. And so again, just a little visual diagram, you can see that when the price of FETH changes by 10%, you see the whole pie has grown, right? You see the reserve ETH has gotten bigger, and the FETH box hasn't really changed much. It's only gone up by about 1%, whereas the XETH box has had to go up by a relative 19% in order to maintain that invariant, that the FETH market cap and the XETH market cap always equal amount of reserve. And so you can kind of see what happens here. Price goes up of ETH a bit, a lot goes into XETH, a little goes into FETH. And of course, likewise on the way down. So let's talk about the net asset value, right? We use this term, it's a typical finance term, but if you're not familiar with it, it's just the current value of one FETH or XETH. And so the protocol itself tracks the net asset value for FETH and XETH at any given time. And we do that by looking at the price change of ETH, forcing the price of FETH to move by only 1% of that, and then applying all of the rest of the volatility to the XETH side. And the protocol is making those calculations and producing this NAV, this net asset value price. And then at any given time, your FETH and your XETH are mintable and redeemable at that NAV that the protocol tracks, right? And so with arbitrage, like if you're buying it, even if you're buying it on secondary markets, having this primary price, always available to mint or redeem at that price allows arbitrage to happen. So you expect that the NAV price, plus or minus maybe a small wiggle, is going to be the true price on secondary and everywhere. So this whole business of XETH and FETH always redeemable That's really important, and it's part of it's like fundamental to how the protocol works. And when you redeem XETH and FETH, you get the treasury reserve, right? We keep calling it ETH here, but in fact, the reserve is denominated. We're looking at denominating the reserve in staked ETH, in Lido staked ETH. So, but the important thing is that the tokens from the reserve are what you are redeeming for at any given time. And then here, just again, to sort of go back to the original example where there was a 10% increase in ETH. If the net asset value for each F and X ETH had been $1 each before the start of this 10% price move, afterwards the NAV for X ETH would be $1.19, and for F ETH would be $1.01. So for minting and redeeming X ETH and F ETH, as I said before, users can mint or redeem for the current NAV. Minting and redeeming does not change the net asset value. It only changes the composition of the reserve. So there's either going to be more FETH or less FETH, or more XETH or less XETH, but the actual NAV does not change when you mint and redeem. And here's an example that KMETS has put together to show that if you deposit $200 and use that to mint FETH only, all it does, see the reserve increases by $200 from 2,000 to 2,200, and you see the fraction FETH increases, but the NAV doesn't change. The NAV, if it was $1 before, it remains $1 after. And likewise for redemption, if you this example here shows a price change. The reserve is now 1.01 ETH, and if you redeem these 200 FETH tokens, you see that the and there was an increase, an ETH increase price, as I mentioned. If you redeem those 200 FETH tokens, you don't change the net asset value. The net asset value started at $1.01 and it ends at $1.01. So I put together these plots to just give sort of like a notional idea of what ETH price, what those price movements might look like. As I said when I showed these the first time, you have to take these with huge salt, because there are a bunch of assumptions in here that are just absolutely not true. Mainly that there is no minting and redeeming as the price of ETH is changing. We expect in particular that both XETH and FETH, their minting and redeeming is going to be sort of a continuous thing, right? And so there's going to be new FETH and XETH minted, and the fraction of F and XETH are going to vary over time. But if you imagine a simplified world where the fractions of FETH and XETH start out equal and they do not change, like nobody's minting and redeeming, you can kind of see what would happen to the price here. Where blue on this plot on the left, blue shows sort of the price of ETH, and I just pulled these are ETH daily prices for the beginning of 2023. We call it good times because it's sort of generally up, and you see that the yellow line shows the XETH, and it's moving by much more, up to 50 and 75% gains, and the red line is the FETH. You can see it's pretty flat, right? It's up a bit, but it's mostly flat. And then I did the same thing for a less happy time in crypto, which was the first part of 2022. And you can see here that it's the same kind of idea, except in the negative direction, right? The price of ETH is dropping, the price of XETH is really dropping, but the FETH is staying pretty much stable, moving by a few percent as you would expect. And in the upper right-hand corner of both of these plots, you can see the breakdown of the reserve, right? The red line shows the amount of reserve that backs XETH, and the blue amount backing the FETH. And you can see that the amount of reserve that backs the XETH varies a lot as the price changes, but the amount backing the FETH stays pretty much constant. Okay, XETH effective leverage. So the actual leverage that you get by holding XETH, like how much does your $1 worth of XETH move? You know, if ETH moves by 10%, we've been using this general example that the XETH is going to go up by 19%, but that's only true if there's exactly half and half minted FETH and XETH. And so here, this plot gives you an idea of in terms of how much FETH versus how much XETH is minted, the actual level of leverage that you get from holding XETH changes. And so the more FETH that exists as a fraction of the total reserve, the higher the amount of leverage that you get. So anytime FETH is minted or XETH is redeemed, that pushes this fraction up, and therefore it pushes the leverage up. And then conversely, on the other side, anytime you come to a lower fraction of FETH, it pushes the leverage down a little bit. So the lowest that the leverage can be is 1.0, but as long as there is any FETH at all in existence, it's going to be higher than 1. And then just that particular fraction is going to determine how much the leverage is at any given time. So that's the big picture here, right? That's how the protocol works, and that's kind of like the main stuff you need to know to how to use it. Now we're going to shift gears a little bit and talk about the protocol stability, because if you've been paying attention, you can see that, you know, as long as there's XETH minted, the FETH holders are protected. But what happens if there's not enough? If we're trying to focus all this volatility of price movement of the reserve and to say of a lot of FETH onto a very small amount of XETH, you know, you see from the previous plot that it quickly gets into this red zone that we call stability mode. It quickly goes, the leverage goes too high, and a severe price movement when the leverage is really high and there's only a small amount of XETH will cause what we call a destabilizing event, where that's the situation where if you have a bad enough price movement, the price of XETH can go to 0. And if that ever happens, then FETH, the token, is no longer protected from volatility, right? Now your FETH is going to move 1-to-1 with ETH because there's no more XETH there to protect it. So to measure the stability of the protocol, we look at something called the collateralization ratio. And you'll recognize this idea from CDPs. If you've ever taken out a loan against a CDP, you provide a certain amount of, like, for example, for Liquidity, you would provide a certain amount of ETH, and then you borrow LUSD, some fraction of the value of ETH. And so your collateralization ratio is the value of your total collateral divided by the value of whatever you have borrowed. And so remember, if your collateral falls below what you've borrowed, you get liquidated in a traditional CDP. And so for us, we don't have that same liquidation mechanism, but that same idea of when the collateral falls below the value of, in our case, the FETH, that's when we lose that protection. That's when that XETH goes to 0. So we measure the collateralization ratio as the fraction of FETH versus the total amount of collateral. And so as long as the collateralization ratio is over 100%, the protocol is alive. But obviously, the collateralization ratio can be it can vary a lot. And in this top example here, you can see there's quite a bit of XETH minted. And so with a collateralization ratio of, we'll call it 166%, there is lots of room. You can have a pretty dramatic price movement of ETH, and there's lots of XETH to absorb it. As the collateralization ratio falls, and you see the second image kind of gives you this idea that, you know, if there's a whole bunch of FETH minted and only a small amount of XETH, now your collateralization ratio is getting low, and you're getting into this risky territory where a dramatic price event could cause some destabilization, which, you know, again, could cause that XETH sort of to go to 0, and then FETH to suddenly have to absorb all of the volatility of the price of ETH. So if the fraction becomes too high, it can become difficult for the protocol to maintain that volatility. We have a risk management module, and this is where the story gets different from what we put out in the first place. I mentioned earlier that we are looking at having the reserve held in staked ETH instead of in ETH, and so the new approach to risk management leverages the yields from the reserve, the ETH staking yields from the reserve, in order to create a much, in my view, better risk management approach. So I'm going to describe that for you here. First things first, how do we choose these thresholds? I've got this number called out here, collateralization ratio of 130%. And we call that the threshold where we start to want to respond, right? And if the collateralization ratio ever falls below 130, we enter stability mode. And we chose 130 by doing value at risk calculation. So looking at all the ETH daily historical price movements since 2017 And so we picked 130 because that's the point where the risk of a destabilizing event rises above 0.1%, right? So in the 0.1% case at 130, that's the threshold where the ETH sort of price movement becomes too much for the XETH to be able to handle. So we call 0.1% of a risk to be sort of the threshold where we say that's as low as we ever want it to go without us doing something about it. So at 0.1%, we engage stability mode. There's two simple things that happen with stability mode. The first is that, there are these rebalancing transactions that will get executed from the rebalancing pool. I'll tell you about that in a second. And the second is that the mint and redeem fee structure is temporarily changed. So in reverse order, the fee structure is pretty simple to understand. Under normal operations, when the CR is over 130, you've got minting and redeeming at 0.25% each. So low fees to enable quick arbitrage and good price parity between the primary market and the secondary markets. XETH minting and redeeming a little bit more at 1%, as XETH is a little bit more of a trading product. But in general, that's like a pretty sort of standard story. As soon as we go into stability mode, where the collateralization ratio falls below 130, we disable FETH minting. So we don't allow new FETH to be minted in that moment. But FETH redemptions are obviously allowed, and they have a 0% fee. And remember that when you remember the earlier slide where we said the protocol becomes the leverage of XETH and the sort of overall leverage of the protocol becomes higher as FETH is minted. And so we don't allow minting. We do allow redemption. You can always get your redemption is always allowed. You can always redeem your FETH and XETH for your share of the reserve. And redeeming FETH is actually a good thing when we are in a situation with the collateralization ratio falling too low. So no fee for that. Same thing for XETH minting. Anybody who wants to mint XETH when the collateralization ratio is low, they do that without fee. And redemption, because we never want to disable redemption for any token, but we do push the fee up in the case of stability mode. Stability mode is not going to last very long, though, because of the use of what we call the rebalancing pool. So because a protocol collateral reserve is held in staked ETH, now the whole collateral reserve is earning these ETH staking yields. And remember, this isn't the situation with a CDP where individual depositors own their collateral. The collateral is held and owned by the protocol. And the XETH and the FETH price movements are based on the price of ETH changing, not some kind of secondary market price of the staked ETH. So all of that to say that the reserve now has, or the protocol now has all of the staked ETH yields of the reserve to play with here. And the main use that they have is to pay yields into what we call the rebalancing pool. So the rebalancing pool is a farming vault for FETH. The idea is that if the collateralization ratio ever goes below 130, then FETH from the vault will be redeemed for staked ETH from the reserve. And remember, that pushes the collateralization ratio back up. It pushes the leverage back down into that stable mode. But what's interesting here is that depositors in the rebalancing pool will earn a share of the staking yields from the reserve. So remember, rebalancing pool is FETH. So this is basically like earning ETH staking yields with a stable coin. You can kind of think of it that way. But the risk or possibly benefit, depending on how you are playing it, is that your FETH could be used to slowly buy staked ETH over time. So you can use the stability mode and the rebalancing pool as a way to slowly buy staked ETH with your fractional ETH over time, and obviously supporting the stability of the protocol as you do that. So here's another one of KMET's. Oh, hey, and KMET's is here. Great. KMET's classic diagrams.
Yeah, I'm staying out of the way. I'm letting you cook, man. You're doing a great job. So
I did not notice you. I did not notice you come online. I
snuck in.
Day late and $1 short, man. I'm on the last slide.
Yeah, I know. Okay, you're doing great.
Do you want to tell the story of the slide, or I can keep going?
No, keep going. You're doing fantastic.
All right. So here's a picture. So we're talking about stability mode and we're talking about the rebalancing pool. So here's a kind of an overview of what the what this kind of all looks like put together. So the reserve is in liquid stake derivatives. It's derivatives. It's in staked ETH, and so it's producing these staking yields, right? And those staking yields, I mentioned that they go to support the rebalancing pool. They also, by the way, go to create revenue for the protocol. And that revenue for the protocol enables us to keep the mint and redeeming fees very low, right? In the first iteration of the protocol, the minting and redeeming fees were the only way that the protocol is actually earning any revenue. But with this new configuration with the staked ETH in the reserve, now the protocol is able to earn a share of that revenue from the reserve of staking, which helps keep those mint redeem fees low. Anyway, I digress. The staking yields from the liquid stake derivatives in the reserve are diverted to token holders and to the rebalancing pool. And then the FETH, which you can see is coming from, you have to mint in order to deposit it in the rebalancing pool. Anytime the CR is under 130, FETH is redeemed for some staked ETH from the reserve. And of course, once the staked ETH is not in the reserve anymore and it's been redeemed and now the rebalancing pool depositors own it, they of course own the ETH as well as its ongoing yields because the staked ETH belongs to them and the staked ETH is rebasing. So it's a really, the stability pool there's a lot of interesting ways to play it, but one of them is just, first of all, farming liquids, like farming staking ETH staking yields with a stablecoin is pretty awesome, as well as the ability to buy staked ETH over time. And I'll also comment that, remember, XETH is not earning any fraction of those staking yields, right? XETH is already, based on the feedback that we've got and sort of our own sort of view, XETH is already a really incredible deal. Like, to be able to take a leverage position and not have to ever worry about the funding rate, like, that's a pretty powerful thing. And XETH is really a trading product, right? It's not a farming product, it's a trading product. People want to trade in and out of it based on the leverage, based on their view of where the market's going. So we're looking at having the entire staking yield of the reserve to be sort of amplified by the fact that it's only going, between FETH and the VEFX token holders, and so kind of can be really powerful. Again, in terms of the details, I can't make any predictions on what the actual yield paid into that rebalancing pool in stability mode is going to be, but it's going to be attractive, and it's also going to be denominated in staked ETH, right? It's pretty cool to be able to earn ETH yields on a sort of a stable deposit. So lots of interesting new stuff there, but that's the big picture. That's how FFX works.
Hey Kruger, did you mention when people stake their FEs into the rebalancing pool that it's essentially, I think what we've determined is it's locked there for a period of time so that it's readily available?
No, I haven't, and I'll
Okay.
I can defer to Charlene for the details about that. I believe we
Okay.
were looking at not so much a lockup period, but just like an unlocking delay, so that we can't have an immediate exodus. So there's something a week or two. Is that right, Charlene? I don't know that we're going to be able to hear from Charlene. She's I think doing a kid run right now.
It's 2 weeks waiting period.
2 weeks.
Okay.
Oh, okay.
Yeah.
For people to get their money back.
All right. Yeah. Good point, K-Mets. Yeah, definitely something to call out there for depositors in the FETH pool. You do have to request your withdrawal 2 weeks prior to actually getting your FETH back out. And again, it's just sort of guardrails put in place to make sure that the protocol is not susceptible to any kind of like liquidity attack on that front.
Yeah, and I think it's also just to ensure that there's FETH in the pool, right? Yeah. So
Well, exactly, right, and you're right. You gotta always have FETH there, but I mean, nothing stops people from withdrawing their FETH from that pool and waiting the
Right.
2 weeks. But the key thing is that you can't do any like flash loan games to try to put the protocol in a vulnerable position and then try to exploit exploit that, right? You've always got to be thinking about
Yeah.
the bad guys.
And it's not like a VE staking or anything. There's no declining rate of your F. It's your FETH is your FETH. It just stays there in the rebalancing pool. The only thing that changes is the LSD that you receive, the staking yields that you receive.
Yeah, exactly. And so I don't know that we have the details hammered out about exactly what percent and how we calculate which of this, like how much of the staking yields are going to the rebalancing pool.
Yeah.
But definitely, I mean, the key factors are you drop your FETH in, you earn staked ETH for being there, and then if the protocol ever enters this stability mode, your FETH is used to buy staked ETH, right? And so you can kind of like you can use it as a way to dollar cost average into staked ETH. I know that the equivalent pool on Liquidity, like Tetranode, famously used that to buy up a whole bunch of cheap ETH during one of the like ETH price crashes, right? You kind of rather than thinking of it as a farm, you think of it as a way to buy staked ETH at a time when the price of ETH may be vulnerable, right?
Yeah.
About XETH. No, XETH, there's no Mr. Massa asking in chat, there's no XETH farming. Like there's nowhere to farm with XETH. XETH is like I say, we're positioning that as a trading product, and so your XETH is never locked anywhere. You can mint and redeem instantaneously, and you can always have your if you want out of XETH, you can do that immediately, and we're expecting there to be a secondary liquidity for that as well, right? So you'll be able to trade it into a pool or to just go and redeem it at the protocol at any time, no delay. And again, one of those things that's really important for a trading product, right? Okay, I'm gonna kill my stream. And we can take if anybody's got questions, other questions online, or we'll plan to end the F of X sort of chunk there if we're going to package that into a video and have that available. But for the community call, we can take any other questions. Anybody who's online or.
And I think right now it's still I guess based on like sort of the timeline that we kind of discussed last week, it's still in sort of code alterations right now, and then it will move to the audit phase for this. So still a few weeks out.
That's right. We were ballparking 6 weeks last week, so everything is still on track. I mean, obviously the time estimates get more accurate the later you get, but we should be code complete within the next week or so, and we're going to need another week on top of that for sort of internal tests before we look at a testnet deployment. So the next big milestone for people to look for FFX is the updating the Sepolia deployed version from the first iteration to the staked ETH back iteration, the LSD iteration with the rebalancing pool.
Yeah, and I think we'll also we'll give people plenty of notice before we do the second phase of the token issuance as well.
Yeah, exactly. There's lots of interest there, but that's still the second phase of the token sale actually happens after mainnet deployment. So we're going to be on to testnet. We're going to run on testnet for a week or two, and then we're going to deploy to mainnet with no liquidity. And during that's kind of like a beta period where we're not going to incentivize any secondary liquidity at all. We're only going to open up FFX for minting and redeeming on the sort of primary market. And then the second round token sale will happen sometime in the first couple of weeks of the mainnet operation, because we're not planning on running beta mode for terribly long on mainnet, particularly with all the great Sepolia testnet operation that we'll have under our belt by then. So we'll operate in mint and redeem only, like no incentivized secondary liquidity until for like I say, only about a week or two. And we'll do the token generation event, which will give everybody their tokens from the first sale, as well as a second sale that will happen around the same time, and then at that point in time, that'll happen at the same time as seeding the liquidity pool with that raised with the ETH that was raised by those token sales, and going ahead with full operations and liquidity mining.
Very exciting.
It is.
All right.
Well, we've hit the top of the hour, and we've made some video here. So unless anybody's got any other questions or anything they want to chat about, then I guess we'll thank everyone for coming out.
All right. Well, good call, everybody. Thanks
Yeah,
for joining us.
Thanks, everyone.
Talk to you soon.
Speak soon.
Okay.
Bye.
Thanks, guys. Take care.
Bye.